Old and Age Index published by the Business Services Group, PwC, found that 244,000 workers aged 55 or over remain economically inactive compared with before the pandemic. Just 64% of workers aged between 55 and 64 are still working, falling to just 56.8% in the northeast of England. Well, Barrett Capellian is the chief economist at PwC and joins me now. Barrett, good to see you. Is this all down to ill health post the pandemic?
Well, it's a few factors that actually explain the employment rate of older workers in the UK economy. One of them is education levels, so the more educated that cohort is, the higher the employment rates. But actually the other three factors is investment income, so that's usually pension fund sort of income, house prices, and the NHS waiting times. So higher or longer NHS waiting times lead to lower older employment rates. Higher house prices lead also to lower employment rates for older workers in the UK economy.
Yeah, so it's a mix. So, I mean, there's good and bad causes. I mean, people being able to retire because the markets have gone in their favour is a good news story.
It is a good news story, but the UK economy has about 1 million vacancies, and we've got a historically low unemployment rate. Put those two things together, it is really a low-hanging fruit for the government to go after the economically inactive people and try to at least reintegrate them into the workforce. That would provide a boost to the UK economy.
There were some real regional disparities that you uncovered. So in the southeast of England, 68% of 55 to 64-year-olds are still working, less than 57% in the northeast. Is that just down to the sort of composition of the workforce?
That is got to do with the composition of the local economies, but also with the differing skills across the different parts of the UK. New Zealand has been really good at addressing the regional imbalances in its economy, and I think the UK economy should learn some of the lessons from the New Zealand economy, actually.
OK, so what do we learn specifically from them?
So what the New Zealand government has done is they've sort of set up the different task force around the country, and they have come up with local solutions for the different regions of the economy. So in some areas, for example, it might be skills-based issues, so the policymakers there are focused on those issues. In other areas, it might have to do with transport, etc. So, you know, it's a local approach to some of these regional disparities of economic inactivity that the New Zealand economy is pursuing.
Yeah, one thing I found quite interesting in your index was that France was relatively low down. Why is that?
It's probably got to do with the retirement age, and we've seen what that means, what that means for France. But I would say that retirement age is a quite blunt tool to actually encourage people to come back into the labour market or not. Japan has been quite successful doing that. But actually, if you really want to encourage older workers to enter the workforce, you really need to skim down the surface. Work with employers, first of all, understand why they're not hiring older workers. Work with employees, understand their skills needs or any other personal circumstances that the government can actually address.
Your implication is there that there's a bit of prejudice on age being exhibited by some employers?
I don't think there is. I think there's a lack of knowledge on the needs and the wants of older workers, in the same way that graduates or younger workers have their own grievances and desires.
All right, Barrett, we've got to leave it there. It's good to see you this afternoon. Thank you. Some other business news stories for you now. And almost 1,000 workers at Gatwick Airport, including baggage handlers, check-in staff and some security staff, are to stage 8 days of strikes from later this month. The Unite Union says its members at the airport will strike initially for 4 days, beginning on Friday the 28th of July and ending on Tuesday the 1st of August. A further 4 days of strikes are scheduled to take place from Friday the 4th of August until Tuesday the 8th of August. Airlines likely to be affected include British Airways, EasyJet, Ryanair, TUI, WestJet and Wizz Air. The UK's Competition and Markets Authority has extended the deadline for its review of Microsoft's takeover of the video game publisher Activision Blizzard by 6 weeks, moving from next Tuesday to the 29th of August. The extension allows the watchdog more time to review proposals by the pair to resolve its concerns. Well, the CMA said in April that it was blocking the $69 billion deal, which has since been waved through by the European Commission, but which still faces objections from US regulators. Burberry has credited a continued recovery in China, its biggest market, after reporting strong sales growth in recent weeks. The luxury fashion group said that during the 13 weeks to the 1st of July, its retail sales were up 18% on the same period a year ago on a comparable basis. Stripping out mainland China, sales were up 11% during the period. Now, higher interest rates have put pressure on commercial property values, just at a time when their owners need to invest more in their assets to meet the higher standards expected by tenants. One solution that's existed for a while is to raise money on IPSX, the world's first regulated stock exchange dedicated to IPOs and trading of commercial real estate. But the cost of accessing new capital on the exchange has proved too expensive for some businesses. So the exchange has responded by seeking to cut its costs. Well, joining me now to talk about this are Anthony Garn. He's the founder and chairman of IPSX, and Robert Taylor, chief executive and general counsel of 360 Law Group. Gentlemen, welcome to you both. Anthony, let me start with you. To what extent has the price dampened activity?
Well, I think actually there are lots of elements that dampen activity. Clearly, the equity capital markets have been fairly low volume in recent times. But the interesting thing, of course, is, and you've phrased it very well in terms of talking about the fact that real estate is in a quite tricky position at the moment with the higher levels of interest costs on, in some cases, quite leveraged assets. But also the change of use. This is the big thing, really, is how things have changed for people, and therefore is the demand for that particular type of building the one that is going to be there in the future. And what we're doing is offering an alternative way of raising capital, either to solve that problem by raising capital from somewhere else, because at the moment this is all in the private markets, and that makes it quite difficult.
So, Robert, what have you done to address this?
We've just made the costs of IPOing the property cheaper by obviously working through our own firm, which is a lower overhead cost base. You know, we don't have properties. We work through a high security IT network, and our lawyers work on that basis, which obviously reduces the overhead cost to probably somewhere in the region of about a quarter of the costs would normally be charged by firms that are traditional law firms that are actually working on capable of doing that market.
Does that mean that someone listing on the exchange or listing a fraction of their assets on the exchange has to now use you by default?
No, they can use any law firm that's capable of doing an IPO of properties. So, you know, it's an open market. They can use whoever they wish. Our lawyers are all very experienced. They're all capable of doing IPOs. They're all capable, you know, they're all very strong corporate lawyers that have sometimes come from Magic Circle upbringings. You know, it's a question of choice, isn't it? It's just that our costs will be significantly lower than they would be if they went to the more traditionally accepted firms.
All right, Anthony, have you made any other changes, or is this the primary thing that you're trying to do to sort of encourage activity?
Well, we haven't actually made any changes to the fees, but the point is we're just making this accessible. The thing is that there is very little capital available in the private markets as we speak today, and that's across different alternative asset classes. But there's a huge demand for alternatives, and liquid alternatives in particular, for asset managers who are looking for something which has a yield and it has a capital gain potential and is maybe just that much easier to understand than a very complicated financial instrument that sometimes is offered.
I remember we spoke to your co-founder a few years ago on this programme. One of the interesting things there was that the rules that you put in place limited properties from being too over-geared property assets. Is that becoming something of an issue given that interest rates have been rising?
Well, I think actually most of the issuers in the market have actually taken a fairly sensible view on leverage. So leverage is less of a feature, and in many cases investors like businesses, which could be companies with real estate assets, which have no leverage at all if they can get the right returns, obviously.
Robert, are you getting much inbound on this right now? Is it among commercial property clients? Are they concerned about getting overstretched?
No, we're not. In all truth, we're not getting a lot of input on it. We are doing a fair amount of commercial property business, but nothing really yet in this regard. No.
So what's driving business activity? Presumably it is some of the bigger players trying to de-gear and offload assets.
Indeed, it is, yeah, exactly. That's exactly what is happening at the moment. And the types of property transactions we're seeing at the moment is exactly coming out of that.
And are there buyers out there for some of these assets?
Yeah, we're seeing some good commercial property transactions at the moment.
And what sort of valuations are they going through at compared with book value typically?
I just pick up the commercial property angle of it, so I'd have to ask my commercial property team, or Anthony.
Well, look, I mean, the valuation of any real estate asset should be the risk-adjusted value of the cash that comes off it. That's what it should really do.
Yeah.
And the difference between a private market transaction where you're just talking about an asset and a securitized property, where in fact you're looking at what's the economic benefit to you, is very, very different. And one has liquidity and one doesn't have liquidity. So that's where the prices sort of change. It's how much do I want to pay to get this income stream, which might be inflation-linked in many cases? And do I know who the tenant is that's sitting behind it? Because that's really what you're looking at. You're looking at the risk of the person who's going to have to pay the rent.
Absolutely. Good to see you both. Thank you.
Thank you.
Still to come here on Business Live. We're going to have a look at how the markets have finished up this Friday afternoon. It's been a very good week for the pound. More on that after this short break.
United Kingdom.
These last few years have seen some huge stories. And these stories have been driven by politics, by politicians, the people in power.
You must stay at home.
And it's my job to figure out how these decisions made by politicians impact all of us in our everyday lives.
This is the worst thing I've ever been through in my life.
People turn up here with their child stuff in a black sack and just say, I don't want to.
And that is what it is. It's first-class poverty.
Is this an example of the welfare state failing?
We take you to the heart of the stories that shape our world.
These are stories that affect us all. Millions of children are now having to catch up. Some stories have changed all of our lives. Because like the residents, the staff are being infected. Politicians, they make decisions all of the time, and it's our job to hold them to account. I wonder if you will take this opportunity to apologise to those families. But in the end, the real power doesn't actually lie with the politicians. The real power lies with the people. I'm Nick Martin. I'm the People and Politics correspondent at Sky News.
I just took a shower above the clouds. You know why? Because this is the Emirates A380. Fly Emirates, fly better.
Welcome back. Now, it isn't widely known, but there is no government licensing of locksmiths, and locksmiths are not covered by the Security Industry Authority that licenses individuals working in specific sectors of the private security industry. Unfortunately, that means there are a lot of rogue locksmiths and scam artists operating around the country. And according to the Master Locksmith Association, the UK's largest trade association for locksmiths, their numbers are on the rise. Well, joining me now is Stefan George. He's Managing Director of the Master Locksmiths Association. Stefan, good to see you.
Thank you.
Outline how big the problem is.
Unfortunately, it's too big. What we've found is since we've started recording complaints about rogue locksmiths, since 2020, we've had about 700 who've come through, and the common thread seems to be the fact that they're found on adverts on search engines. But our concern is that that's probably just the tip of the iceberg, because that's only the ones who have bothered actually reporting it. What about those who haven't bothered? What about those who are perhaps too scared to? And it's also just one industry. What about all the others? So we really think that the search engines have a duty to engage with us, to look at what sort of criteria they put in place to allow people to advertise on their platforms.
And what sort of change have you had out of them thus far?
Nothing, unfortunately. No, it's interesting, actually, because Google themselves, they stopped advertising locksmiths abroad. I think it was Germany and some Scandinavian countries. But we've tried to engage with Google UK, for example, and we've had nothing back.
That's pretty shocking, isn't it, given... I mean, these people are preying on the elderly and vulnerable, by and large.
They are, absolutely. I mean, if what tends to happen is when you need a locksmith, you're in a vulnerable state, you're not sure what's going on. So that's why they're using the search engines, because people think that, oh, if you're at the top of a search engine, you must be good. No, if you're at the top of a search engine, you've got a large marketing budget. That's all it is. So what we're saying is people shouldn't rely on using search engine adverts. They should actually know who they're going to use before they actually need a locksmith. So if they visit locksmiths.co.uk, they can take the details of their nearest MLA licensed locksmith, put them into their phone, and that way they're not going to use an advert and they're not going to be ripped off.
And what are the most common scams?
It tends to be bait and switch. So it's always a very cheap advert, around about £39, £49. And then they just keep repeating that price, and then they end up charging hundreds, if not thousands of pounds.
Oh, I mean, it's as wicked a crime as you can think of, really, isn't it?
It really is, and it tars everyone with the same brush. It really damages our industry as a whole, which is why we have an approved company scheme where they're vetted, inspected and qualified. But, as you said, there's no government regulation at all, so anybody can call themselves a locksmith.
Yeah, why is that?
It's a very good question. They regulate other parts of the security industry, but not locksmiths. I mean, we had an MP that created a debate for us at the House of Commons, and one of the ministers there said that there was no need to license locksmith because the MLA does it already. They suggested that consumers use the MLA for its resources and that locksmiths join us, but that's all good and well, but it would be great if it was a bit like the gas safe register, where it was government mandated but run by a third party. So if we were running the scheme and it was government required to have an approval, that's what we would love to be.
Because presumably there's a cost involved for you for registering your members.
There is, yeah. We have to go through various processes. I mean, we changed the law on the vetting of locksmiths back in 2009, so they're vetted, we go out and inspect them, they have to pay some exam-based proof of competency. So there are costs involved, but then with the promotion that they're getting, they tend to get that back straight away.
Yeah, and the key thing is you are a non-profit organisation.
Absolutely,
You're there for the good of the industry.
Everything goes back into the industry, back into regulation, into promotion, all that kind of stuff.
All right, Stefan, really good to see you this afternoon. Thank you.
Thank you.
Well, European stocks have finished the week in fairly uneventful fashion, but they're still on course for their best weekly gains in 3 months. All the main continental European indices in negative territory at the close, apart from the CAC 40 in France. Very appropriate, that, you might think, for Bastille Day. Well, the main talking point in Europe today has been Nokia, the Finnish telecoms equipment maker. Shares down there 9.25% in Helsinki following a profits warning this morning. Well, here in London, the FTSE 100 has also finished in negative territory, albeit only by 5 points or so. Losses in energy and mining stocks have been balanced out by gains for industrial and consumer stocks. The engineer Spirax Sarco is the leading blue chip gainer. It's finished up some 3.5% after receiving a push from one of the brokers. Outside the FTSE 100, the white label cleaning products manufacturer McBride, you can't see it on the screen there, it's finished up 20% on news that profits for the year will be much better than expected. On Wall Street, all of the main indices are off to a strong start following the bank results, but the asset management giant BlackRock, its shares are off by nearly 2% after a 1.4% fall in quarterly revenues. On the foreign exchange markets, the US dollar has clawed back some of the losses it's incurred during the last 48 hours. As you can see, sterling off nearly a fifth of 1% against the greenback. The pound has nonetheless enjoyed its best week this year. As for the oil price, well, that's given back some of the week's advances, but it still looks set to complete a third consecutive week of gains. A barrel of Brent crude will currently set you back $80.09 a barrel. That is down 1.5% on the session. Well, joining me now is Michael Field. He's equity market strategist at Morningstar. Michael, good to see you. Obviously, Wall Street off to a decent start this afternoon, all driven by the banks. Largely positive results from them.
Good to hear finally some good news on banking after the crisis that we had in March. So I think investors are very appreciative of that. So I think the first earnings season after the banking crisis, the concern was whether there was going to be contagion, whether what we were going to see was going to roll on to other banks, the problems. And what we're seeing out of this earnings season now is banks actually posting some decent profitability results, driven by interest rates rising. So I think investors are seeing that interest rates might be high for a little bit longer than we expected, and they think the banks can benefit from this. So that's where you're seeing the gains coming from today.
Yeah, I mean, I guess we can't read across too much to the wider US economy on how well the banks are doing, because it's largely a function of rising interest rates.
For the most part, yes. I think you have to look at some of the other economic indicators in the US as well. Unemployment, for instance, it's still very low. So from that perspective, you'd expect that the balance sheets, their assets, defaults and stuff should be okay for the moment. So that should be, not something we're particularly concerned about as well. Insolvencies also, the numbers aren't rising at a worrying rate either. So those two kind of indicators together would give you some kind of positive view on how the bank should perform, at least over the next few months.
Now, the highlight of this week for most people will be the US inflation figures, which came out really healthy indicator. Inflation coming down at a fair old clip now in the United States. Still not back to the Fed's target rate, but nonetheless going in the right direction. Is it too early for the Fed to sort of say mission accomplished here, do you think?
Possibly. I think the worst thing, the thing they want to avoid the most is having to flip-flop on what they're doing, to suddenly cut rates and then find by the end of the year they actually need to raise them again. So I think that's their main concern. So while they might take their foot off the gas a little bit and see how things play out, see if inflation gets back to that target inflation level by itself almost now, I think you still could see some rate increases coming through. And the expectations in the market are still for a number of rate increases before the end of the year. So we will wait and see.
Now, these sharp interest rate rises around the world are sparking issues for lots of business sectors. You've just published a report on the insurance sector, I gather.
We did. We published a monster 60-page report just recently looking at the health of the insurance sector. So I think investors had been concerned that perhaps the insurance sector would be next after the banking sector, the issues we saw in March, very exposed to rising interest rates. And we think that's the case. So particularly within Europe, inflation and rising interest rates are causing all sorts of problems for insurance companies. But the kind of upshot from our report is that we don't think you're going to see some kind of mass contagion effect on the back of that. We would kind of caveat that, though, by saying that if you're investing in the insurance sector, you have to pay particular attention to the individual stocks there, how healthy their balance sheets are, and if they're actually robust enough to kind of get them through the next year or so where you still have high inflation and high interest rates.
All right, Michael, we've got to leave it there. Good to talk to you this afternoon. Thanks very much indeed for joining me.
Thank you.
That's it from me. I'm back again with Business Live next on Monday morning at 11:30. Look at that weather behind me. It's a miserable old afternoon here in the Square Mile. Not looking forward to walking home in it, if I'm honest with you. Have a good weekend. I'll see you on Monday. Thanks for joining me today. Cheerio.